Today we are diving into a powerful new interview with Tom Lee, the head of research and chief investment officer at Fundstrat Capital. He joined CNBC's The Exchange to talk about the Federal Reserve's latest interest rate decision and the outlook for the market, alongside Barry Knapp from 𝗗𝗟𝗧𝗖𝗢𝗗𝗘 Macroeconomics. And according to Tom Lee, the market is about to shock everyone. In his words, investors are not ready for what comes next. I am going to show you the clip of Tom Lee on CNBC, and right after that, I will break down exactly what he said and give you my own reaction to his outlook. Then we will move into a detailed analysis of 3 cheap stocks to buy right now. Hit the like button. Let us try to get 1,000 likes on this video, share it, and drop your thoughts in the comments. And of course, subscribe to the channel so you never miss the next important financial investing update. Let us hear what Tom Lee has to say.
Barry Knapp, the director of research at 𝗗𝗟𝗧𝗖𝗢𝗗𝗘 Macro, and Tom Lee, Fundstrat Global Advisors managing partner. Welcome to you both. Tom, you're more, I don't want to make it sound like you have a point of view other than you're expecting a more hawkish Fed, and Barry, you're expecting one that's a little bit more dovish. So Tom, you're more in line with consensus right now. What would that look like, and why are you still bullish on stock prices?
Well, I think precisely because our clients are expecting a hawkish cut. So exactly as Steve laid out, Fed does a cut, but future cuts are uncertain, not even maybe until June. Now, because that's the base case, then if that's what happens, of course, markets have already been bracing for that, and they've been bracing for it since October. And of course, there's a chance that it's a dovish cut, which would be bullish as well. And then I think
what to you would be a dovish cut? So, are there projections? Are there dots?
Yes.
There is. So we'll know right away if they come out and those projections show that they're expecting more rate cuts next year. Then you're saying we might only get one more in the summer.
That's right, and it could also be interpreted dovishly if they start acknowledging the balance of risks are shifting, so that then markets can realize the Fed is now acknowledging there's some underlying fragility of the economy, and of course now QE is because QT is ending. It's essentially not QT, which is QE, and there's, of course, the chance that there's something positive the Fed has to say. So I think it is a hawkish cut, but actually I think market reaction's positive.
And there's so much more you're queuing up here we're going to get into, but on a top level, why isn't it a bigger roadblock for markets, Tom? You could look at this and just say, well, we're already basically at all-time highs. Look at the Russells and so forth. And Powell's been known to not have a very favorable reaction to his commentary, and he's only got a few meetings left, so maybe he's even more hawkish than usual. I don't know. Why don't you think that's a bigger risk? Whether it's, I'm not just myopically even talking about this afternoon, but, kind of setting the tone into year end and then into next year.
Yeah. I think part of it is just the market's now adjusted to the idea that the Fed is institutionally slightly hawkish. Now, part of it may be because that there could be undue pressure coming from outside the Fed, and the institution wants to protect its integrity, and that comes across as hawkish. But that dynamic is something the markets have been bracing for, and they've reacted negatively to it, like in October they did. And so I think because of that, that's what people are building into this December meeting, which is why it could be a surprise.
It's like when Apple always gives cautious guidance. The stock always sells off after earnings, and then it does fine again. And they also, of course, have the post-COVID period to react to, where you know that someone like Powell, who's about to leave, is going to want to say, I didn't reopen the door to inflation. Right?
Yeah, that's right.
For that
Protect his
institutional
legacy.
Exactly. So, Barry, all of that said and done, there are still lots of people starting to talk about this quantitative easing issue. So it's a little bit confusing when you have, are we to view that even as economic policy making, or is that something completely different that just has to do with the plumbing of the financial system?
So for 3 years, you and I have been talking about the Fed eased primarily using their balance sheet, but tightened using only one of 3 channels that they have, which is they've just been draining reserves from the system. And so that's the plumbing issue, which is getting tight. But the much more important and impactful part of QE is when they're buying Treasury notes and mortgage-backed securities. That lowers long-term rates, which is what really influences equity prices and other risky assets. And they suppress volatility by buying mortgage-backed securities because of prepay.
The big picture here is that Tom Lee is expecting what he calls a hawkish cut from the Federal Reserve. That means the Fed can still lower rates this week, but they will speak cautiously about future cuts. And Tom is pointing out something very important. That scenario is already expected by the market. Investors have been preparing for a cautious Fed since October, which means a hawkish cut is not some surprise that will shock the market. The real surprise, according to him, would be if the Fed actually gives us a more dovish tone, and that would be extremely bullish. Tom made a great point about how clients and investors are bracing for a tough message. That is why he believes even a hawkish cut can still push the market higher, because expectations are already so low. And if the Fed even hints that the balance of risks is shifting toward weakness in the economy, or if they start acknowledging that the economy is becoming more fragile, the market will take that as a sign that deeper cuts are coming later. Tom also highlighted something that many investors are not paying attention to. The Fed is finishing quantitative tightening. Once QT ends, the Fed is essentially moving closer to providing support again, which many investors refer to as a type of early-stage quantitative easing. That shift alone creates a more supportive backdrop for stocks. Tom also talked about the possibility that the Fed's projections could show more cuts next year than what the market currently expects. If that happens, then it is no longer just a hawkish cut, it becomes a bullish cut. That is where the market could be caught off guard on the upside. Then the conversation shifted to whether this Fed meeting is actually a major threat to stocks. The host pushed hard on that idea, especially since markets are near all-time highs and Jerome Powell is known for delivering comments that make investors nervous. This is where Tom Lee made another key point. He said the market has already had time to adjust to a Fed that is institutionally hawkish. In other words, Powell and the Fed want to protect their credibility. They do not want to look like they made a mistake by cutting too early and letting inflation flare up again. But the market has been dealing with that tone for months. Investors already priced it in when markets sold off in October, so the downside from that style of communication is not as big as people think. Tom compared this dynamic to Apple. Apple always gives cautious guidance. The stock sells off, and then it stabilizes and goes right back up because investors already know how Apple behaves. The Fed is doing the same thing now. They are being conservative because they want to be remembered as the team that did not allow inflation to explode again. That is especially true for a Fed chair who is nearing the end of his time in office. He wants his legacy to be strong. Markets understand that. That is why Tom says the market is ready for this, and that is why he thinks the market reaction can still be positive. Then, we moved into the discussion about quantitative easing and the plumbing of the financial system. Barry Knapp jumped in here to explain something that confuses a lot of investors. For years, the Fed has been affecting markets by adjusting the balance sheet. When they ease, they do it by buying assets. When they tighten, they mainly do it by draining reserves from the banking system. Right now, that reserve system is becoming tight again, and that tightening is happening behind the scenes, not through interest rate hikes, but through how the Fed manages liquidity in the system. Tom Lee's earlier point connects directly to this. As QT ends, the underlying pressure eases, the system becomes more liquid, and that is generally supportive for markets. So when you step back and look at everything Tom Lee is saying, here is the real takeaway. The market is prepared for bad news, which means the bar for disappointment is actually low. The Fed can give a hawkish cut, and the market can still go up because investors already braced for the worst. But if the Fed gives anything even slightly more positive, or if their projections show more cuts coming, then this could become a strong tailwind going into year-end and into next year. That is why Tom remains bullish. Even with high valuations, even with the Fed sounding tough, and even with markets sitting near all-time highs. He believes the setup is better than people think, and he believes the next move can still be upward once markets digest the Fed decision and understand the real direction of policy. That is the full breakdown of Tom Lee's interview and why his perspective matters right now. Now let's dive into the 3 cheap stocks to buy right now. First up is United Parcel Service, ticker UPS. You know the brown trucks, but UPS is much more. It's the backbone of global commerce, connecting businesses and consumers in over 220 countries. From bustling cities to remote villages, UPS is the invisible thread that keeps the world's economy humming, ensuring that goods, documents, and vital supplies reach their destinations on time, every time. Millions of packages move through their network daily. The infrastructure, technology, and expertise UPS has built over decades create a moat that's nearly impossible to breach. Their global network is a marvel of modern engineering, with state-of-the-art sorting facilities, advanced tracking systems, and a workforce trained to handle anything the world throws at them. UPS has survived recessions, pandemics, and economic shocks. Why? Because e-commerce keeps growing, and every online order needs delivery. When the world shut down, UPS kept moving, delivering essentials and keeping businesses afloat. Their resilience is a testament to their adaptability and the essential nature of their services. As shopping shifts online, UPS is the essential link between sellers and buyers. The more the world shops online, the more UPS wins. Every click of the Buy Now button sets off a chain reaction that ends with a UPS delivery, making them a silent partner in the global e-commerce boom. Recently, the stock pulled back due to union negotiations, fuel costs, and economic worries. But these are short-term issues. The long-term story is intact. Temporary headwinds are part of any business, but UPS's scale and experience allow it to weather storms that would sink lesser companies. UPS is a cash machine with strong free cash flow and a reliable growing dividend. For investors, that means both potential appreciation and steady income. Their financial discipline ensures that even in tough times, shareholders are rewarded and the company remains on solid footing. Even if the stock price stalls, you're still collecting dividends, a classic value play. It's the kind of investment that pays you to wait, rewarding patience with consistent returns. Competition exists, but UPS's reputation for reliability and its B2B strength set it apart. The market is big enough for several players, but UPS is the gold standard. Their relationships with major corporations and small businesses alike are built on decades of trust and performance. They're not standing still. UPS invests heavily in tech, route optimization, automation, and data analytics to boost efficiency and margins. Their commitment to innovation means they're always finding new ways to deliver faster, smarter, and more sustainably. The recent labor agreement, while costly, removes uncertainty and lets UPS focus on execution. With labor peace secured, management can double down on growth initiatives and operational improvements. Globally, as emerging markets grow, demand for logistics will only increase. UPS's network is ready to capture that growth. As new economies rise and global trade expands, UPS is positioned to be the delivery partner of choice for the next billion consumers. The brand is a global symbol of trust, built over a century, and not easily replicated. Few companies can match the legacy, reputation, and customer loyalty that UPS enjoys. UPS is also expanding into high-growth areas like healthcare logistics, a specialized, high-margin business. From delivering life-saving medicines to managing complex supply chains for hospitals, UPS is becoming indispensable in critical industries. The current valuation is attractive, strong fundamentals, a healthy dividend, and a stock price below historical averages. For value investors, this is a rare opportunity to buy quality at a discount. This is classic value investing. Buy a great company when short-term fears create a discount. The fundamentals are sound, and the upside is compelling. Don't let headlines distract you. The world will always need things moved from point A to B, and UPS is the toll road. Every package shipped is another toll collected, and that's a business model built for the long haul. United Parcel Service continues to be a central force in global logistics, supported by a market cap of $84.53 billion. The company trades at a price-to-earnings ratio of 15.40 and delivers earnings per share of $6.47. For 2024, UPS generated $91 billion in revenue and produced a net income of $5.78 billion, underscoring the strength of its global shipping network despite economic headwinds. For long-term investors, UPS is a foundational piece, a smart, calculated bet on the infrastructure of the global economy. It's the kind of stock you can build a portfolio around, confident that it will deliver for years to come. It's not flashy, but it's reliable, profitable, and positioned for decades of growth. In a world of uncertainty, UPS offers stability and steady progress. At today's prices, it's an opportunity worth serious consideration. The market may overlook it now, but patient investors know the value of a business that delivers, literally and figuratively. If you want a stock that lets you sleep at night, UPS is it. It's the kind of investment that doesn't keep you up, worrying about the next big disruption. The combination of entrenched position, e-commerce tailwinds, shareholder returns, and a discounted valuation makes UPS too cheap to ignore. It's a rare blend of growth, income, and safety. It's a toll road for e-commerce, and as an investor, you collect a toll every time a package ships. That's a powerful position. Few companies offer such a direct link to the unstoppable rise of online shopping. UPS is a smart, calculated investment in the infrastructure of the global economy. As the world grows more connected, their role only becomes more vital. Don't miss the chance to own a piece of it. This is a company built for the future, and the future is arriving faster than ever. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Next, let's talk healthcare. Specifically, Novo Nordisk, ticker NVO, the Danish pharmaceutical powerhouse that's not just transforming diabetes and obesity treatment, but is also reshaping the future of global health. This is a company that's become synonymous with innovation, reliability, and hope for millions of patients worldwide. For decades, Novo Nordisk has been at the forefront of diabetes care, building a stable, recurring revenue stream with life-changing treatments. Their expertise in insulin and other therapies has made them a trusted name for patients and healthcare professionals alike, and their commitment to research has kept them ahead of the curve. But what's really put them on the map in recent years is their breakthrough in obesity drugs, Wegovy and Ozempic. These medications are opening up a massive, previously untapped market, offering hope to millions struggling with weight management and related health issues. The buzz around these drugs is not just hype, it's backed by real-world results and surging demand. Obesity is a global epidemic, affecting people of all ages and backgrounds. Novo Nordisk is the first mover with effective, in-demand solutions that are changing the way the world approaches this crisis. Their leadership in this space is setting new standards for what's possible in chronic disease management. Yes, the stock has run up, but the market still underestimates the long-term potential. Demand for these new therapies is outpacing supply, and Novo Nordisk is investing heavily to scale up production and meet the needs of a growing patient population. The company's ability to execute on this front is a testament to its operational strength. Don't just look at last year's earnings, look at the growth ahead. As production ramps and regulatory approvals expand into new countries, revenue and profits are set to soar. The company's global reach means it can tap into emerging markets as well as established ones, multiplying its growth opportunities. Novo Nordisk's innovation engine is strong with a robust pipeline targeting not just diabetes and obesity, but other chronic diseases too. Their research teams are constantly pushing boundaries, developing next-generation therapies that could address cardiovascular disease, rare blood disorders, and more. Their moat is built on a foundation of patents, complex manufacturing processes, and deep, long-standing relationships with the global medical community. This combination makes it incredibly difficult for competitors to catch up or replicate their success overnight. They have significant pricing power. These aren't commodity drugs, but essential life-changing therapies that patients and doctors rely on. The value they deliver justifies premium pricing, supporting strong margins and reinvestment in future innovation. Global trends, aging populations, rising rates of chronic disease, and increasing awareness of preventative care mean demand for Novo Nordisk's products will only grow. The world's healthcare needs are evolving, and Novo Nordisk is positioned right at the center of this transformation. Competition exists, of course, but the market is enormous. Multiple winners can thrive, and Novo Nordisk's first-mover advantage is huge. Their established reputation and early lead give them a powerful edge as new players enter the field. Financially, they're a powerhouse. High margins, strong cash flow, and the ability to fund R&D, expand manufacturing, and reward shareholders. Their balance sheet is rock solid, giving them flexibility to invest in future growth and weather any storms. The impact goes far beyond profits. Effective obesity treatment could reduce heart disease, joint problems, and healthcare costs worldwide. The ripple effects of their therapies could improve quality of life for millions and ease the burden on healthcare systems everywhere. Risks exist, competition, regulation, side effects, but Novo Nordisk's track record and resources are unmatched. Their experience navigating complex regulatory environments and commitment to safety set them apart in a challenging industry. The stock may look expensive now, but with the growth runway ahead, today's price could look cheap in a few years. Long-term investors who look beyond short-term volatility may be rewarded as the company continues to deliver. This is a rare chance to invest in a company improving global health and delivering strong returns. Novo Nordisk is not just a business, it's a force for positive change in the world. Massive, unmet need, best-in-class products, a deep pipeline, and fortress finances make Novo Nordisk a compelling long-term play. Their ability to innovate and execute is second to none. The market is huge, the moat is wide, and the growth story is just beginning. There's still so much potential ahead as new therapies reach more patients and new indications are explored. This is one of the most influential pharmaceutical companies in the world, backed by a market cap of $217.95 billion. It trades at a price-to-earnings ratio of 13.51, with earnings per share of $3.63. The company reported a massive $290.4 billion in revenue for 2024 and delivered a net income of $100.98 billion, driven largely by the global demand for its diabetes and weight loss treatments. For patient investors, Novo Nordisk is a unique opportunity in the healthcare sector. It's a chance to participate in a story that's both financially rewarding and socially meaningful. Don't be put off by a high share price. Quality and growth are worth paying for. In a world full of uncertainty, companies like Novo Nordisk stand out for their resilience and vision. Novo Nordisk is fundamentally changing lives and creating value for shareholders. Their story is one of progress, purpose, and performance. It's a healthcare innovator with a long runway ahead and a proven ability to adapt and lead in a rapidly changing world. If you want exposure to one of the most powerful growth stories in the market, Novo Nordisk deserves a spot on your watch list. This is a company that's shaping the future of medicine. Now let's shift to the digital world for our final pick. Our third pick is Adobe, ticker ADBE, the digital creativity powerhouse whose products are so essential they've become verbs. Whether you're photoshopping an image, illustrating a logo, or premiering a video, Adobe's tools are woven into the fabric of modern creative work. Photoshop, Illustrator, Premiere Pro, Adobe's Creative Cloud is the industry standard for creative professionals worldwide. From solo freelancers to massive agencies, these tools are the backbone of digital content creation, powering everything from viral social media posts to blockbuster films. Their shift to a subscription model was a masterstroke, creating predictable, recurring revenue and funding relentless innovation. Instead of one-time purchases, users now pay monthly or annually, giving Adobe a steady stream of income and the ability to invest in new features and technologies. Adobe's moat is massive: high switching costs, deep integration across its suite, and a network effect that competitors can't match. Once you're in the Adobe ecosystem, it's hard to leave, thanks to seamless workflows and industry-wide adoption. The failed Figma acquisition spooked the market, but the core business remains rock solid, and the stock hasn't fully recovered, creating a buying opportunity. Investors worried about competition, but Adobe's dominance and innovation engine are still intact. Beyond Creative Cloud, Adobe's Experience Cloud is a fast-growing business, helping companies manage marketing, analytics, and e-commerce. This platform gives businesses the tools to understand their customers, personalize experiences, and drive sales in a digital-first world. This end-to-end solution serves the entire content supply chain, expanding Adobe's reach and diversifying revenue. From content creation to delivery and measurement, Adobe is involved at every step, making it indispensable for modern enterprises. The market still undervalues the Experience Cloud's potential. Adobe is more than just creative software. Its business solutions are quietly becoming just as critical as its creative tools, opening up new growth avenues. AI is a huge opportunity, not a threat. While some fear AI will disrupt creative work, Adobe is harnessing it to empower creators, not replace them. Adobe's Firefly generative AI is integrated into its products, making creative work faster and safer for professionals. With Firefly, designers can generate images, edit photos, and experiment with ideas in seconds, all within the trusted Adobe environment. Unlike standalone AI tools, Firefly is trained on licensed content, so businesses can use it without copyright worries, a major differentiator. This focus on ethical AI and copyright safety gives Adobe a unique edge, especially for enterprise clients. Financially, Adobe is a machine: high margins, consistent growth, and strong cash flow, fueling R&D, acquisitions, and aggressive share buybacks. Its financial discipline allows it to weather market storms and keep investing in the future. The stock trades at a discount to historical multiples due to Figma deal noise, but the fundamental thesis is unchanged. For patient investors, this is a rare chance to buy a world-class company at a reasonable price. Adobe is a digital toll booth. Every time digital content is created, there's a good chance Adobe gets paid. Its software is the gateway for creativity in the digital age, and the toll booth keeps collecting as the world creates more content than ever. Their ability to innovate, adapt, and expand into new markets shows world-class management and vision. Adobe's leadership has consistently anticipated industry shifts, keeping the company ahead of the curve. Don't let short-term headlines distract you from the long-term quality of this business. Adobe's track record of growth and resilience speaks for itself. The failed acquisition is behind them. What remains is a dominant, highly profitable company with multiple growth drivers. Adobe's future is built on innovation, not just past success. Adobe holds a market cap of $145.55 billion and trades at a price-to-earnings ratio of 21.38. The company produces earnings per share of $16.05, supported by $21.5 billion in revenue for 2024 and a net income of $5.56 billion. This performance highlights the power of Adobe's subscription ecosystem and its dominance in digital design. For long-term investors, Adobe is a fantastic way to own a piece of the digital transformation. As businesses and individuals shift more of their work and lives online, Adobe's relevance only grows. The world is only getting more digital, and Adobe powers that shift. From advertising to entertainment, education to e-commerce, Adobe's influence is everywhere. It's a blue-chip tech stock currently on sale. Opportunities like this don't come around often for companies of this caliber. This isn't a get-rich-quick play. It's a durable, high-quality business with a long growth runway. If you're looking for stability and upside in the digital economy, Adobe fits the bill. Market dominance, recurring revenue, strong financials, and a reasonable valuation make Adobe too cheap to ignore. It's a rare blend of growth, profitability, and resilience. If you want exposure to the digital economy, Adobe is a must-have. It's not just a software company, it's a foundational pillar of the digital world. Don't miss this window to buy a best-in-class software company at a fair price. The opportunity to invest in a leader like Adobe doesn't last forever. That wraps up our 3 undervalued giants. Let's talk about your next move. There you have it, UPS, Novo Nordisk, and Adobe. 3 industry leaders trading at attractive valuations for long-term investors. These companies power e-commerce, solve global health crises, and drive the digital creative economy. They each have massive moats and clear growth paths, perfect for building a solid, diversified portfolio. Want more in-depth analysis and exclusive stock tips? Join the Stocks Galore Patreon, link in the description. Which sector, logistics, healthcare, or software, do you think has the most compelling growth story for the next decade? Drop your thoughts in the comments, like, subscribe, and I'll see you in the next one.